And we're live. Welcome to this WCM Investor webinar. I'm Marty Switzer, the CEO of Contango Asset Management. We represent WCM here in Australia. With me is Portfolio Manager live from Laguna Beach, Mr. Jon Tringale. Welcome, John.
Thanks for having me, Marty.
Good to have you here, mate. Now, before we start, if anyone has any questions in the second half of the webinar, we will be taking questions from the audience. So you can enter those questions into the screen, and those questions will be facilitated here in our office. WCM are the manager of two investment products that we represent here at Contango: the WCM Quality Global Growth Exchange Traded Managed Fund, ASX WCMQ, and the WCM Quality Global Growth Listed Investment Company. Both these products give our investors access to the WCM Quality Global Growth strategy through either an exchange traded managed fund or in a listed investment company. And now, before we start this presentation, or I should say, the purpose of this presentation is to talk through some of the challenges that investors are facing at the moment, but particularly to focus on how WCM investment strategy performs in down markets and how the manager is investing right now. So, John, we'll kick off the session. So, for those that don't know, we've got a few new investors in the room today, or potential investors, I should say. Give us a bit of the background of WCM, mate.
Certainly. So WCM, we're based here in Laguna Beach, California. We're an independent, we still consider ourselves boutique asset manager. We run about $32 billion US, primarily in global growth equity strategies. The strategy of which we're talking about today, of course, is the quality global growth, where we're looking to invest in 30 to 40 businesses around the world that we think offer the greatest risk reward prospects over a 5+ year time horizon. We're employee owned. We have ownership throughout the organization. There's about 49 of us here at the firm, and really our reason for existence, why we all skip to work every day, is to generate alpha and outperform. That's what's fun to us, and scouring the world for those opportunities really drives us.
Yeah, fantastic. Now, John, what makes WCM unique compared to its peers is the investment process. So talk us through how that works.
Yeah, I think it's a challenge certainly for anyone to be unique in the long-only space, and I certainly believe that we are. And there's a few different ways that I can go about explaining how we're different. I think first maybe is to contrast what we do with maybe some of the more conventional methodologies that you'll see among managers. And what I mean by that is you'll probably run into a lot of funds out there that buy into this idea or invest through this idea of buying high quality, because no one admits to buying junk, companies with big competitive advantages or a wide economic moat, which is a metaphor popularized by Warren Buffett, of course. And they're trying to buy these businesses at a discount to their intrinsic value. So we're of the view that, when Buffett popularized this idea 30 years ago, there was probably a lot of low-hanging fruit by buying a quality business with a big moat cheap. Today, that's simply not the case. You have too many smart people around the world trying to do that same thing, and there just aren't really any inefficiencies to exploit by investing like everyone else. And I think worse than that, that type of methodology can lead you to value traps, where you can destroy massive amounts of capital because the business has some big competitive advantage, and it's maybe cheap, but it might be cheap for a reason, and it might keep getting cheaper because the business could be being disrupted, and so on. And you can be fooled if you're just looking for that wide moat. So how we think about things a bit differently, and we do focus much of our attention on the investment team on competitive advantages, but we view it from the lens that any business we look at, their competitive advantage is very dynamic in nature. The business is either getting stronger or weaker vis-a-vis its competitors. And it's really that change in competitive advantage that drives stock returns. And so what we're trying to do that's a bit different is fill this portfolio with 30 to 40 businesses, not that have a competitive advantage, but where we can make a compelling case that competitive advantage is increasing. And so as we look out 3, 5, 7 years into the future, the moats, economic moats of these businesses will be wider than they are today. And that's really going to drive the results.
Now, what about culture? That's a key part of your investment strategy, something that makes you really unique. If you look at what's happening here in Australia at the moment, we're going through where we've just had a royal commission into the financial services industry, where the culture of a lot of these organisations has been seriously questioned. talk us through the role that culture plays in the investment process at WCM.
Yeah, it's critical. And I think culture has become maybe a little bit more of a buzzword lately, and you hear people throwing it around more. But to us, it means a lot. Just to give you a little bit of a background, I think our belief and our conviction that culture really matters for business performance is driven from our own history. WCM has been around since 1976. And for the first probably 22 years, we had a very different structure, a very different culture, and the firm really struggled to grow. And since we've made some changes, we've experienced a different level of success. And we view that it's important for any business. I think if you're investing, if you're trading stocks and you're in and out of names in less than a year, culture maybe doesn't matter so much. But philosophically here at WCM, we're looking to own great businesses that we want to own for the long term. And that's where culture, we feel like, can be just a huge advantage if you know what to look for and if you get into the right situation. So I guess our belief that this culture matters is born from this idea that we all, I think, intuitively have, that people matter. And I think most of us have probably worked in jobs where you felt empowered, you felt like you could make a difference, you were incentivized well, you were treated well, and that probably brought out your best work and your highest levels of productivity. Contrast that with maybe if you've been in a situation where you weren't appreciated, you weren't paid well, and you didn't have the same motivation or drive. When you multiply that across an organization of 10, 20,000 people, that's a pretty powerful force. And I think intuitively, again, we know that makes a big difference. So that's, I guess, foundational. And I think the next stage is, how do you identify a great culture? What are you looking for? And how do you find the right match for the business? So we start with this belief there's not some perfect culture that every company should have. There may be some common elements that we look for, but we attack it more from the lens, what's the competitive advantage of this business? What's the business model? Is it a low-cost provider? Is it an innovation-driven business? Is it a luxury business? Is it a retail business? And does the culture they have support and enhance the competitive advantage that they have? Because if it does, if you get that nice alignment where the culture supports the strategy and the competitive advantage, those businesses can keep growing that competitive advantage for a lot longer than people expect, and really drive that outperformance. I think on the flip side, when you're competing against a challenge culture where people are leaving, they're not focused, they're spending time maybe looking for a job, and you own the company that has that really nice alignment, they can exploit that advantage for a very long period of time.
Jon, who's the pin-up boy in the portfolio when it comes to culture?
There's a lot of directions I could go, but I think one that we could start with would be Costco, which is one of the large holdings in the portfolio. So I think that makes it particularly relevant. It's a large warehouse retail business. I'm not sure. Are there Costco's near you?
There are. Yes, there are. Yep.
So it's the classic, membership-based model. You pay a fee to shop there, and then you get low prices on a really wide variety of merchandise. They compete in the U.S. very closely with a business called Sam's Club, which is the exact same membership warehouse retail business model. We could teleport to the inside of a store right now and look around, and we wouldn't know if we were in Sam's Club or if we were in Costco. But when you look at the financial metrics of the two businesses, they couldn't be more different. Costco has literally double the sales per square foot. They've got same-store sales comps 3-4% better every single month, it seems. And they've got profitability and margins that dwarf Sam's Club. And so as one maybe ponders why this is, let's take a look at what type of a business it is. It's a retail business. Now, we would argue in retail, culturally, it's important that you better take good care of your people. You better pay them well, because if you have happy employees, they're going to provide better customer service. Customers are going to come back more, and you're going to ultimately have happy shareholders. And when you dive into some of those metrics for these two businesses, you'll find that Costco they pay their people very well. They have good health insurance benefits. They help pay for college. And as a result, and they've created this environment that people enjoy working, and it's resulted in about 13% employee turnover. So people stay, they're happy. Contrast that with Sam's Club, where they don't pay well, they don't have the same benefits, and the employee turnover is about 50%. And I think that helps to start explaining the huge gap in the financials. And I think one of the beauties, again, is that's not an overnight fix to turn around Sam's Club's culture. Not that it can't be done, but it's not something that's going to happen in a quarter or two. So I think so long as that remains the case, that Costco has a superior culture, we believe they can continue to keep outperforming Sam's Club.
No, very good. Jon, can you tell us about a company that you bought because they had a change in their culture?
Yeah, there are quite a few examples. And there's certainly plenty of examples of companies we've sold because the culture has become more challenged. Yeah. But on the buy side, I think of a company like Tencent, which we first bought back in 2012. I think it's become more of a household name since then. But at the time, they were very focused on desktop. They were in some more ancillary markets. But around that time, they started to turn their attention to mobile. And as part of that, they realized they had to attract really top engineering talent, top developers. And they created this organization around WeChat, which is very well known now, but created a certain level of freedom and a compensation structure for their engineers that was based completely on user satisfaction, not on revenue, and gave them freedom to start from scratch on a mobile platform rather than trying to merge or morph a desktop chat into mobile. And I think that's really some of those decisions and around the culture really enabled them to push the innovation to now have, the dominant platform with WeChat with over 1 billion users.
So let's sort of touch on the macro. Now, I know it's not a core focus for you, but the world's been incredibly challenged at the moment on the back of trade wars, Brexit, bond yields, the list goes on. What's your view on the macro environment? But probably more importantly, what are the companies that you invest in saying about the economy right now?
Yeah, great question. And really the macro backdrop has changed quite a bit in the last 12 months. If we were talking a year ago, we were probably talking about this idea of synchronized global growth. We were seeing GDP accelerating almost on a global basis. Even parts of Europe that had no growth were starting to show a little bit. And that's really changed. I think you've seen a divergence in the health of some of these different economies globally. And then layered in, you have a lot of geopolitical shifts. You have a lot of uncertainty around rates, trade. So it's an interesting environment right now. I think the volatility that has resulted here of late has actually been something we've welcomed because it's creating more dislocations in prices, and we've been able to make a few upgrades to the portfolio of late. But in terms of our view, we, as you alluded to, we pay close attention to the macro. We're paying attention to where do the businesses we're looking at have exposure that could impact the fundamental business, and being careful on how we position the portfolio from that standpoint. But we don't take a real strong view that we think we know what's going to happen and how the markets are going to react, because it's just too hard to get right consistently. So portfolio construction is important, making sure that we're diversified on the key components and that we are feel really a lot of conviction in the positioning of our businesses. And that really dovetails into the other part of your question, which is what are these businesses saying? If you look last quarter, I think it's been pretty well documented that you've had, record high profit growth here in the U.S., at least for the last number of years, and certainly tax cuts has helped that. But we're seeing, on the most part, really strong fundamentals. We're seeing pretty high confidence from these management teams. I would say the one notable exception to that would be in some of the large capital expenditure industries, maybe areas like factory automation, where businesses are going to invest, tens of millions of dollars into new robotics and factory automation equipment. We have heard more cautious comments from management teams at companies like Fanuc, for example, where because of the trade uncertainty, there may be delaying some of that CapEx investment. And that's hurt certainly some of the businesses in that part of the market. But apart from that, there's uncertainty, but there's also, I'd say, have been a stronger sense of good performance and good fundamentals.
Now, an area where the portfolio since inception has been particularly impressive is on the downside. So talk us about the downside capture strategy that you've deployed. How have you achieved this? Because over the last 10 years, it's been 53%. Run us through it.
Yeah, and that's really the proof statement for our strategy and really for all our strategies. And it starts with this very fundamental belief. One of our core investing principles here at WCM is the way you win the investment game over the long term. And that's what I referenced at the beginning, what excites and drives all of us. A big part of how we do that is by protecting capital well, because we all know how the math works. You lose 50%, all of a sudden you've got to go up 100% to get back to even. So everything we do on the stock selection side and the portfolio construction side is aimed first and foremost to protect well on the downside. So practically, how do we do that? I think the first point, and I talked about that idea of competitive advantage change, we refer to that as moat trajectory. We want to own businesses where the competitive advantages are strengthening. And so that's been really helpful to get in front of great growth businesses we want to own for the next 5 years or more. But to the point of downside capture, that methodology has been more helpful on the sell side and the avoid side. Avoiding some of the value traps like a Nokia or a Dell or a Tesco that are great businesses according to many, but they're not getting better, and they ultimately being value traps. So I think our sell discipline around, once we can no longer make the case that a competitive advantage is growing, if it's no longer growing, it's out of the portfolio. We don't get cute with hanging around. So the stocks we've avoided, and I think we've also we've made plenty of mistakes, but we've tended to be earlier and better sellers of stocks than many, and that's gone a long way on the downside. And then I'd say complementary to that has been portfolio construction, and I could talk about this for hours on end. I feel like it's one of the lost arts of this business. As we all know, you could have two portfolios with the same 35 stocks and put up completely different results, depending on how you size positions, how you move positions around, and so on. So we're very intentional to be diversified around the world with the portfolio's revenue sources. There's a foundational view that there's a lot more economic risk and sensitivity where our businesses are earning their profits than where they're domiciled. So we try and stay fairly balanced. We also are intentional to have a mix of different type of growth profiles in the portfolio. So we are a growth manager, but this isn't a high octane, screaming growth, super high beta portfolio. We're going to have some of those names, the Shopifys, the Tencents, that are a lot of fun to talk about. But we're going to also have some more defensive growth names that are going to be your anchors to the wind in periods like we've seen these last couple months, that are going to be steady eddies. They're going to keep putting up 4 or 5% growth when the market's expecting 2 or 3. They're very consistent, and they're going to be safe haven. So having the right mix of those is important.
Jon, let's talk the audience through portfolio performance over the calendar year, and also how the portfolio is going to be positioned in 2019 from a sector perspective. Yeah.
So, we've been fortunate that 2018 has been a really strong year performance-wise on a relative basis. I didn't check today, but I think we're close to 800 basis points ahead for the year. And most of that has been driven by stock selection, which historically has been the case. I think any attribution you run on us will show about 80% of our alpha has come from selection. In terms of positioning, we're most heavily exposed in healthcare technology. We feel like that position really, that exposure really puts us in the best position to take advantage of some of the global opportunities we're seeing. I think in healthcare specifically, you have a couple big drivers over the next decade. You have aging populations with more and more healthcare demands and requirements on a global basis. And at the same time, you have much larger commitments to grow healthcare spends in certain emerging economies with really large populations. Places like Brazil and Indonesia that have pledged to double the amount of their healthcare spend over the next decade. I was in China recently. You talk to folks in their hospitals and healthcare system, and you ask, are you really going to grow spending 18% the next 5 years? And they say, yes, we have to. So we want to participate in that growth. To get a little more granular, we don't believe the winners of those ideas will necessarily be the big pharma companies with the $40,000 drugs. Or the biotech companies where you have to bet on some binary event, a drug approval. So we've chosen to play that more of a picks and shovels approach or a toll booth approach, where we're owning companies that sell a lot of the basic testing equipment, devices, supplies, tools that are going to be needed at every hospital and outpatient volatility. Companies that have great products, but also have low cost structures, good distribution, and are really positioned to ride that wave with a lot more consistency and a relatively low correlation to the rest of the market and the macro. So that's one area we really like. And then also technology continues to be driving just a lot of the innovation that we're seeing in the world, and there continue to be really attractive opportunities that are finding their way into the portfolio.
Great. Now, Jon, before we go to questions, which we'll do in a moment, just talk us through one of the companies you really like at the moment in the portfolio. You mentioned a couple, but focusing on one that maybe we don't hear as much of here in Australia.
Yeah, I'm guessing you probably haven't heard a whole lot about Shopify. Is that it's a Canadian?
That's fair. Yeah, I think absolutely. Let's talk through that.
Yeah, it's based in Ottawa. Basically, they're a point solution or an operating system for merchants, anyone who has a product to sell, to go direct to consumer. And this is one of the bigger themes we've seen in the consumer space the last 5 years, is this direct to consumer movement. I think most of us know it well with the large e-commerce players like Amazon or Alibaba or Mercado Libre in Latin America. But there's also brands that are going direct to consumer themselves. And Shopify is really enabling that, from everything, building the digital storefront, helping with payment processing, logistics, even the marketing effort, and so on. And they fit an interesting gap in the ecosystem. So I think most people assume if I have a product to sell, I'm going to go to Amazon. They have this huge audience. Why would I not? And but there's a couple reasons. And if you think about Amazon, what they're all about, what drives them, their culture, is they're all about adding as much value as they can for the end consumer, getting them the lowest prices, getting them the fastest shipping times, bundling more services in their Prime membership so that they're really feeling like they're getting good value. But as we think about who's lost in that equation, we would argue it's the merchant, because if I'm selling my product on Amazon as a third party, not only does Amazon control where my product comes up in a search, they own the data on who's buying what, who's clicking on what, which I would love to have that as a merchant. And probably most significantly, they take a huge commission. Globally, typically it's around 20%, whether it's Amazon, Alibaba, or Mercado Libre. That's about the going rate. So that's a huge commission to pay. Whereas if I'm a merchant and I go with Shopify, and by the way, most people will do both, but if I'm with Shopify, they're creating the design however I want it. I own the data. And by the way, they're going to take on average 1.5% commission, less than a tenth, and help me go direct to consumer. So they're very early in their runway. They have about 5% penetration here in North America, almost nothing elsewhere. And so we think it's very early days. If you look last quarter, they grew revenue over 60%. And this is a business, because of the way that technology works, is going to have, we think, enterprise software type of margins, just huge operating leverage. And they're really in the pole position to lead this direct to consumer market around the world.
And they've also made the Kardashian family even richer, I believe, yeah?
Indeed.
Talk us through that very quickly for those that don't know what I'm talking about.
Oh, which one?
Is it one of the Jenners has built a $1 billion business off the back of, who's related to Kim Kardashian, for those that don't know who Jenner is, and she's built a multi-billion-dollar business off the back of Shopify, yeah?
Yeah, it's called Kylie, and it basically is cosmetics for women. And yeah, she's built over $1 billion business. The interesting thing for Shopify is they do small merchants that we've never heard of. They also power e-commerce for companies like Tesla, which I don't think a lot of people realize. So yeah, it's the whole range: Kylie Jenner, Tesla, and my buddy who sells protein bars.
Very good, very good. Now we might go to some audience questions. Tom, you got them there? First question. So we got first questions from a guy called Luke in Lennox Head, and he's actually asked, what does downside capture actually mean? So I was just looking at the computer there, that's why I was off camera.
Yeah, so downside capture measures if the market's down, how much are you down relative to the market? And for our purposes, the market is typically use the All Country World Index by MSCI, which is which is an aggregation of all the equities around the world. So basically, a downside capture of 53% means if the market's down 10%, then on average, we're down 5.3%. So it's how much of that drawdown in the market are you capturing?
Okay. Next question is from Mick in Melbourne. He says, I've heard WCM, and you mentioned in the presentation before, talk about picks and shovels companies. Again, what do you mean by this, and are there any examples of this in the portfolio?
Yeah, good question. So picks and shovels is a reference to the gold rush in California in the mid 1800s. And it's really this notion that when everyone moved west and was searching for gold, there were a few lucky people who struck gold and who got really rich. There were a lot more people who, in their pursuit of the gold, went broke, went bust. But the people who were selling the picks and the shovels and the pans that were used for the mining made very consistent, nice livings for a long period of time. And so they participated in this theme, but without being the ones to take all the risk and the high likelihood of going bust. And so we've really used this approach in a variety of industries in the portfolio. I think one example that comes to mind that's one of my favorite businesses that we own is a company here in the States called West Pharmaceutical. And they're in a pretty mundane sounding business of pharmaceutical packaging. And I'm not talking about the cardboard boxes or the plastic that maybe you see at the drugstore. I'm talking about the glass test tubes, the vials, the rubber stoppers, the syringes that are in direct contact with these drugs, particularly liquid drugs. And it's a really interesting business because West Pharmaceutical, they make about 40 billion individual packaging components per year. They have about 70% of the global market for pharmaceutical packaging. And what makes it so attractive is that according to the Food and Drug Administration here, regulatory bodies around the world who approve drugs, any components that are in direct contact with the drug are considered part of the drug for regulatory standards. And so that means in layman terms is if a drug is approved by the regulators, it goes to market with a certain packaging. If they want to switch packaging suppliers, they would have to go and do brand new clinical trials from scratch to prove that the drugs still work the same way with the other packaging. And so the result is, companies never switch packaging companies, and West is really the default high quality provider. And so that's a huge moat or huge competitive advantage to start with. And I think the moat is growing because we're seeing this move to more complex liquid biologics is one of the big trends in healthcare. We're seeing more generics. We're seeing push for lower cost alternatives. And the types of packaging that those products require are higher cost and they're higher margin for West. So you have this fastest growing part of their product portfolio is also the most profitable. And we would refer to West as being a picks and shovels play on biotech and on healthcare and on just the proliferation of healthcare without having to pick any individual winners of what company is going to have the great new drug in this particular patient population. So they're just participating in the general growth of the whole market.
Next question is on emerging markets. What's your view on emerging markets and what sort of exposure does the portfolio currently have to it? And this is from Bob from Bexley.
Yeah, good question. Emerging markets, a lot of people like to talk about emerging markets like it's one entity, but the reality is it's a consortium of markets that have very different outlooks at any given time. What we're seeing in China is very different from what we're seeing in Indonesia or Brazil, for example. So for us, the key is looking bottom up at these businesses at who has great prospects and they're trading at a compelling price. So the portfolio exposure today is about 10%. I should mention that the bar to get into the global portfolio, this best ideas portfolio, 35 holdings, it's a very high bar to make it in. For an emerging market name to make it into this portfolio, the bar is even higher. So every emerging market business we own has net cash on the balance sheet, for example. But I think more important than that is every EM company we own is one of the most dominant businesses we've seen in the world. Whether it's Taiwan Semiconductor, who makes 60% of every semiconductor chip in the globe, or if it's a company like Tencent with 1 billion users on WeChat. So we're playing in a very small slice of the emerging market broader asset class, which tends to be more cyclical in nature. It has high weights to financials and energy materials. We're playing more in that kind of healthcare and technology part of the market.
Thank you. So the next question's from Nick Barnaby, talking about the ETF and the listed investment company, wanting to know what the major differences are. Really a structural question, so I'm happy to answer that, John.
Okay.
The listed investment company, for those that don't know, is a closed-ended fund. It's a listed product where the ETMF, and sometimes called an exchange-traded product, is an open-ended fund. Both those vehicles give you access to the WCM Quality Global Growth investment strategy. The thing about a closed-ended fund is that there are only a specific number of shares. It's it's closed-ended, and when a fund is closed-ended, it can trade at discounts and premiums, where with the exchange-traded managed fund, we ensure liquidity because the fund is open-ended. So basically, with the ETMF, you will always be able to invest in that product at NTA, where with a closed-ended fund, you'll be able to buy that product sometimes at a discount and potentially at a premium as well. So they're the key things to consider. There was a little bit more information in that question as well. We'll give you a call, Nick, to cover off a couple of other of those points as well. So I think that's all we've got time for. Yep, it's 10:32. John, thank you very much for your time today. It's great to be working with you, and we look forward to hosting you in one of these webinars in the very near future.
Yeah, likewise. Thanks again for having me, and thanks everyone who dialed in.
Good on you, mate. Talk to you soon.
All right, take care.
That's all we've got time for. Have a great day, guys.